So we're gonna move on, and Brad from GreenGen is going to present.
Hey, thanks, Mike. So I'm going to just spend just a couple minutes talking about sort of, from my point of view, what do buildings need? What do they want? What are the opportunities that you can potentially develop? And if you go to just the next slide, just to give you a quick sense of sort of the perspective I'm coming from. Next one. So, my background before starting GreenGen was really yeah, there we go. Was on the real estate investment side. I came out of real estate private equity. I started at JMB, which at the time was the largest real estate firm in the country. I spent a decade at Starwood Capital, one of the leading global opportunity funds, founding their business in both Asia and Europe. And then finally running the East Coast for CalPERS, State of California Public Employee Retirement Fund, pension fund backed firm doing development, particularly in DC and New York. I also sit as a global governing trustee of ULI, the Urban Land Institute, which is the leading organization focused on the built environment, and sit on ULI's Sustainability Center board globally. And so I have a very interesting perspective. It's not just about sustainability or decarb, but it's really how can you do that profitably? And at the end of the day, your idea has to be profitable. It has to drive ROI. There has to be an ROI for every dollar that you're looking or asking someone to give you. And if you do that, there'll be lots of interest. If you don't, there'll be less. Go to the next slide real quick. Um, the work we're doing around the world is for about two-thirds of our businesses leading global investors. So just to give you a sense, it's Blackstone, it's KKR, it's Starwood, it's Brookfield, it's Macquarie, it's the leading global firms. These firms, gently put, are very greedy. I don't say that in a mean way, but the point is, everything we're doing around sustainability or decarb or net zero has to be profitable. And if it's profitable, there's a lot of interest from our investors and our clients. If there's not, they're out. They're not going to work with us. They're not going to do anything. And so it's critical to have that business case. Well, let's go to the next slide, please. So let me start with sort of two questions I think you should be asking. The first is, what do buildings need? First and foremost, they want to see their expenses reduced. In a time where real estate broadly has demand challenges, lower occupancy, pressure on rents, whether it's coming from the economy, whether it's coming from the federal government, basically wanting to take less space, the first and easiest way to drive ROI is to reduce expenses. And the key expenses are electricity, which is generally the largest. It is water. Increasingly, water on a percentage basis is going to increase more than any other commodity. Why? Because we've underinvested in CapEx. We haven't kept pace with all the infrastructure that delivers water to you. And finally, in the last couple of years, we've increasingly seen insurance as a really interesting category of spend. We used to talk a lot about, the cost of insurance. Increasingly, the question is not the price of insurance per se, but it's the availability of insurance at all. Whether it's Los Angeles, whether it's Florida, various physical climate risks and climate events are putting tremendous pressure on the insurance industry. And we're seeing, prices and costs of insurance go up. And it becomes a really interesting lever of potential ROI depending on sort of what we're doing. And I'll give you an example of that at the end. But also less transitional risk. When we talk about transitional risk, we're really talking about regulation. More than 50 municipalities around the country today have some form of regulation. Typically, it comes with some sort of expense or climate tax or carbon tax. In the Washington area, you have it in DC, you have it in Maryland, you have it in Montgomery County, you have it in Arlington, Fairfax. We live in an area with tremendous pressure and basically sticks, if you will, but also New York, Boston, Chicago, Denver, all manner of different areas have it. And the pressure is actually much higher today than it has been a couple of years ago. As the federal government has come back and applied less pressure on the built environment or gone backwards, we're seeing every other stakeholder, particularly cities and states in the US, countries outside the US, equity investors, debt investors, occupiers, their employees, their customers, their supply chain, all basically push more, push faster, in a much more onerous state. Transition risk is very high. And in some cases, like New York, you're seeing buildings that have potential for more than $1 million a year of carbon tax or some other type of penalty. And depending on the amount of it, that could be upwards of $20 million of equity. It is an enormous piece of pressure, but it's also an enormous opportunity if you can find ways to address it and mitigate it. Low carbon materials, embodied carbon, that's concrete, that is steel, but it's also a myriad of other things. It's different technologies. It's cross-laminated timber using wood as opposed to concrete and steel. It's also smaller staff. What I mean by that is, can you provide or identify technology that reduces the need for people? An office building perhaps 10 years ago would have had 10 people working on it, engineers and staff. Today, that same building might have 2.5 people. The pressure on headcount has been significant. And these are all teams now that have less time to be doing more. And so if we can find ways to have technology replicate best practices or people and to do things more efficiently, that's a really important thing. And that, to the next point, is a pain point. What are the staffs doing, whether it's a property manager, engineer, asset manager, owner? What are the things that they're doing that they don't want to do or take up a lot of time? And can we identify or create a technology to do it better? There are all manner of things like that. It's sensors, it's controls, it's software overlays that basically look at weather data to basically help Scott and his utility predict, do a better job. So when they have a demand event where they have to have fast dispatchable power, there's less pressure, and they will pay you for reducing the energy that you're using in a building. And then better technology. Better technology is essentially either a cheaper technology, so it's doing the same thing but at a lower cost, or at the cost it was before, it is more powerful. So there's a greater return on each dollar. Each of those, both of those are really valuable to people and building owners. And so let's go to the next slide. And so the question you should be asking is, what's your big idea? And there's different ways to think about that. It could be technology. It could be a better sensor. It could be a better light, but it also could be a better business model. The reality is today, we're not really inventing brand new types of solar. The big innovations in solar, for example, is the business model. How does the solar get on your roof? How do you identify the opportunity? How do you finance it? How do you put it on the roof? How does you make that process efficient? The same too on financing energy efficiency. CPACE is a good example of that. They're not upgrading your building. They're finding a better business model to deliver the savings and the improvement on design to your building. And then, key things I think are, who buys it? Who actually needs your technology? Is it the building owner? Is it an integrator? Is it a sensor that goes into something else? How do they buy? Are they buying the hardware? Are they basically, buying the software as a service, energy as a service? What's the different way to buy it? Is it they put up the money? Do you finance it? Do you put up all the money and they pay you a service fee? And then finally, what I was saying before, the business case. It is critical for you to think about the ROI. When we talk to clients, we don't basically recommend or advocate them putting up $1 without giving them really explicit ROI for that. We have to help them understand how it is in their interest, whether it drives the value of the asset, or the other big thing in our world is helping people access capital more efficiently, raise money faster on the equity side or on the debt side, better terms, higher proceeds. Let's go to the next slide. The challenges that you will face, and this is 15 years of doing this, so this gives you an advantage and a leg up. Who do you compete with? As whether we're using a technology or whether we're investing in technology, I will tell you that we've never had a company that has done a good job of thinking about who they compete with. Time and time again, we hear companies say we're the only one that does this. And my reaction is, you're not just the only one who, you're not the only one who does. In fact, you're not the only one within, your block. I know one other company that's around the corner from you doing it. I know 10 other companies in Washington, D.C. that are trying to solve for the same thing. So, be honest with yourself, and understand the competitive landscape. What are you doing? Why is it better than other people? How do you acquire customers? It's really important to understand who your customers are and how are they actually going to buy it. How do you get to them? Whether it's direct mail, whether you have to know them, what does that sale look like? How does someone buy your thing? What's the business model? What's the business case for it? And probably really, really important that people often forget about is, how do you actually demonstrate ROI? It's one thing to say this will save you money, but where's the data set for that? Where's actually the business case that demonstrates that? There are some things, for instance, reducing electricity, that are pretty easy. There are other things that are, I think ROI is frankly a more nuanced problem to be solved. And you have to really, think about what are the right KPIs and how do you actually get that data, both the baselining, where were you before the intervention or your technology, and then how do you actually, once you've done your work, how do you actually demonstrate that ROI? Let's go to the next slide. So let me just very briefly give you an example. Conservation Labs is a company that we work with that we've also invested in. It comes out of Carnegie Mellon. It is based in Pittsburgh. Their big insight was that water leaks insurance costs more than 80 billion US dollars a year. It's pretty boring. It doesn't hit the papers. It's not something people think about, and yet it's an $80 billion a year issue to the built environment. Conservation Lab said there's got to be a better way to both think about identifying that there's a water leak, but also the cost of the event itself. And their innovation was essentially to put an acoustic sensor to listen to the water pipe and water infrastructure, listen for a water leak. There is a very clear acoustic pattern to a water leak. And they basically found a cost-effective way and very quick to install to put the acoustic sensor on the pipe, and then have the ability to have that device link into a valve, if you want, on the actual pump or water infrastructure, so it can cut it off. This is a pain point. This is about thinking about people. If you had people that could sit in your building 24 hours a day all over the place, they could listen to this. They could look for the water leaks, but there's a better way to do it, to use the acoustic sensor cost effectively to do it, and then link it into the cost of the event by shutting down the valve really quickly. Great insight. Insurance companies are paying for it. Multifamily is paying for it. Hotels are paying for it. And at the end of the day, let's go to the last slide, please. At the end of the day, we know that these innovations are able to drive both a financial outcome with a sustainability outcome at the same time. This is what we do in our business. This is what it means to operate in the green, have both a profitable intervention that is also driving a sustainability or climate outcome.